Welcome to this week's update on the hedged option portfolio. Since last week's video, Bitcoin has chopped around between 94k and around 102k. This choppy action has been good for the account, but there are a few trades I want to do in the account today, so let's get straight into it. Let's head over to Deribit. You can see these are the current positions. I'm already short a put and a call for tomorrow, and I'm short a call for next week, and that was a roll from yesterday, if I remember correctly. And I'm still holding all of this longer dated protection. So what I'm going to do first today is sell a put for 2 days. I'm currently short 2 calls, so I want to be short at least 2 puts as well. And the second thing I'm going to do is adjust this longer dated upside protection, these calls here. Because given how long they've got left, they've still got more than 6 months left, they're actually quite close to the money now. So I'll likely roll those out in time and up in strike price as well. I'll do a couple of different things with them, you'll see in a bit. So first things first, let's sell a put on the 14th of December expiry. Probably go for the 100k, I think. I normally go for around 30 to 35 delta. There's nothing actually in that range for this expiry, so I've just got to pick slightly higher or slightly lower. Doesn't really matter too much which. But my delta at the moment is slightly negative, so I can lean a bit higher in the strike price here because that'll give me more positive delta. I would hope to get filled here soon, as my offer is a couple of basis points better than the mark price. And of course, as I say that, the price rallies away. I'm not in too much of a rush today though, so I'm happy to just leave this and see what happens. I can always adjust the order if necessary. You can see here that the price, the underlying price, is rallying a little bit. We're up $100 or $200, I think, from the time I placed the offer. So I could consider adjusting the price of my order here down. And in fact, I think I will do that, as I've got a few other trades to do as well. So I'll adjust that down to 90 basis points, which is around the current mark price. You can see this is turning into quite a good example of what can happen when you're trying to get filled in the middle. Sometimes the price will just move away and you won't get the fill you wanted. So rather than just continue to chase this down, I'm going to leave this order open for now and go and adjust the calls in the June expiry. So we'll see what happens with this order later in the video. We're rejoining the account here about 90 minutes later because I had a short power cut and it took me a little while to get everything back up and running. But in the meantime, the order to sell the 100k put on the 14th of December expiry was filled at 90 basis points, and it's now in a slight bit of profit. So with the short dated positions taken care of, it's now time to adjust the calls in the June expiry. So we're on the June expiry already here. So the reason I want to adjust this is that these are providing too much protection now. What I really need the protection to do is provide tail risk protection. I don't need my positions protecting from like a 10 or 20% increase in the underlying price. That's fine. I can deal with that with just rolling the shorter dated positions. So this call protection in June at the moment is holding too much value basically. So I might as well take a bit of profit on this one that's provided some decent cover so far, roll it up in strike, and also roll some of it out in time as well. So by the end of this process of adjusting that I'm going to do today, I'm going to be holding more long calls, but they're going to be further out of the money. Some of them are going to be further out in time. And I'm also going to take a little bit of profit on what's been made so far. Now we're in the June expiry here, which is more than 6 months to go. And there's a lot less activity in these expiries than there is in the short dated stuff. If you've watched any of my videos, you'll know I quite often like to try and get filled in the middle. So if we were looking at this 120k strike and I was looking to sell it back, I would, if this was a shorter date, I would put an order in at 1440, for example, and then try 1435. That doesn't always work on these longer dates. It will if you're very patient, but the volume is simply lower on these dates. So you're not always going to get filled like that. You might have to cross the spread. Hopefully not fully, but yeah, sometimes you will. So let's see how well we can execute these trades. I'll try and obviously get as little slippage as possible, but if you look at the equity here, I expect this to go down. The more slippage I get, the more this will go down at least temporarily, because this equity figure at the top is including the value of all your positions at the current mark price. So if you get filled at worse than the mark price, it's going to put a little dent in your equity. It's not a huge deal, it's just a fact of how it works. So first things first, let's stick an order to sell some of these 120k calls in June. And I'll sell a couple of them. Hopefully, I'm going to try 1440 here, but I really don't expect to get filled here. Not quickly anyway, unless the underlying price moves. Wow, got filled straight away, so that was a nice surprise. The underlying price moved a little bit, so that's not too surprising. Right, so now I'm going to buy 2 of these back. So I'll try 6.9. Again, not expecting to get filled there quickly. Yeah, this time I don't, but that's fine. I'll just roll the price up a little bit. I'll cross the spread if I have to, but if I don't have to, there's no need. There we go, got filled at 695, and the best ask was 705. So just by trying to get filled in the middle, you do save yourself a few basis points. So I sold 2 of these at 14% and bought 2 of these at 7%. So I've actually collected more credits than I've spent at the moment. What was this? Maybe 14 that I've spent and collected 28. So I've got 14 I could spend theoretically, roughly, without having done a net debit to the account. And for this one, I will go out to the September expiry. And I want to buy a couple of calls. Probably going to be looking at these 200s, maybe a little further out. In fact, what I'd quite like to do is buy some of these 200s and sell some of the 300s to reduce the price a little bit. So I'm going to buy some 200s, sell some 300s. I'll probably buy 0.3 and sell 0.3 of the 300s for now. And then when these 300s decay, I'll buy those back for hardly anything and I'll be left with the long 200s. Unless we shoot up, obviously, in which case they'll both gain value. Now, I could try executing this in the order book, but I'm going to try a combo for now. So let's go to the combo screen, create combo, and it's a call spread, a vertical, and it's going to be on the September expiry. Now we create the order book. Doesn't matter, you don't need to fill anything in here. Then go to the combos list, open up this, and hopefully a market maker will put a quote in here soon. Okay, so there's no quote coming yet. So what I'm going to do is just stick a bid in anyway and see if that triggers any market maker's bot to come in and start quoting. And there we go. You can see that did trigger a market maker's bot to come in and quote this. It's not a great quote. On-screen ask is 0.043, and the market maker's quote is 0.0427. And on-screen, yeah, so it's basically on the on-screen price. It would still be better to execute, if it is exactly the same, it's still better to execute via a combo because you'll save on one of the legs. But we could probably execute at a slightly better price just directly in the order book. But what I'll try first is moving this order up in price. Because, yeah, this is what he's quoting, but someone might fill me if I just roll the price up a little bit. Doesn't always work, but there's no harm in trying. So 4% hasn't worked there. I'm happy to go quite a bit higher as long as I can beat the on-screen price. But if we start getting close to the on-screen price, then I'll just go try my luck in the public order books, or the individual order books, I should say. This is all public still. I don't mind overpaying slightly when I'm doing this longer dated kind of trade because I'm going to be holding it for so long, 10 or 20 basis points even. I'm going to make that back with the short dated positions anyway, so it doesn't matter too much, but obviously you might as well get executed at the best price possible. I'll roll this up a little bit more to 410. You can see this market maker's matched my size there. And someone did fill me at 410, so that's nice. So I haven't overpaid too much there, and I've saved on one leg worth of fees by doing it via a combo. So let's go to take a look at the positions again. So you can see this spread has now been executed on the September expiry. Now long 0.3 of the 200 calls and short 0.3 of the 300 calls. So it's a decently wide spread, and the 300 calls just lowered the cost of it, basically. And the total cost of this was less than I just collected for selling one of the June 120k calls. So we got some okay protection out in September now as well, which we didn't have before, to the upside. Now I still want to make another adjustment, because if you look at this 120k call in June, it's basically a 50 delta at the moment. There's nothing intrinsically wrong with that, but the long calls I'm holding are supposed to act as protection against very large moves for my shorter dated call selling. So I really don't need to be holding long calls so close to the money with so long left until expiry. It's more than 6 months left. So I'm going to try and sell another one of these and roll it up in strikes on the same expiry. So there we go, sold another one of those. And I'll buy a couple of the 200Ks, but in June this time. Try 370, probably won't get filled. I'm going to do this in double size as well. So I sold 0.1 of the 120k calls, which collected 14%. And with part of that credit, I'm going to buy 0.2 of the 200k calls, which will cost me about 7.5% most likely. Yeah, I suspected that wouldn't get a fill, so I'll just roll the price up to 375. Hopefully that will get filled. And there we go, we got filled on that as the underlying price and the price of calls was ticking down there. So let's just take a look at what we've done so far, or the resulting portfolio at least. You can see the delta is roughly what it was before I did all those adjustments. You can see, as I mentioned at the start, that the equity has gone down a little bit because I did execute at worse than mark price for a few of those. Some of this will just be the fluctuation of the price, but I was expecting the equity to come down while I made those adjustments. So I did have a bit of a 120, 160k bull call spread in June. That's now just some long calls in June, some on the 200k and just 0.1 of the 120ks remaining. And I've also got a bull call spread in the September expiry with a size of 0.3. So the total size of everything has increased, but most of it has moved further away from the money. So these 200k strikes are only really protecting me from a large increase in the underlying price, which is more what I want. So I've got 0.1 of the 120k call remaining. I'd still like to adjust that because, as I said, I don't really need 6 month protection of only 20% out of the money. That's excessive. So I'll go and sell this one now as well. And I'll just keep some of that credit and probably buy one more out of the money call in either June or September, probably September. I'll buy another one of the 200Ks most likely. So let's do that now. It's gone. Now I'll go out to September and just buy one more of these. Bump this up to 670. 670 still not getting filled, so I'll just bump this up to 675. And there we go. So I've now closed all of the position I had on the June expiry and rolled some of it up. But the old positions I had on the 120 and 160k strike, those are all gone now. I've rolled some of them up on the same expiry to 200k, but then I've placed another larger position on the September expiry. And the long is also at 200k, but I've also paired that with selling some of the 300s just to reduce the cost a little bit. So I've still got some naked calls to the upside, but obviously the bulk of this is really just a bull call spread. So this is the resulting portfolio now. Still the usual short dated positions, basically short some strangles, and then those are protected against any really big moves with the longer dated positions. These longer dated positions won't do much if we crash 20% or pump 20%. These aren't going to provide much help in those scenarios, but that's fine because I can deal with that with just rolling things out in time. So the portfolio is looking roughly how I want it now. I've still got upside protection, but it's now further away from the price than it was and in larger size. And I do have downside protection, which is in much larger size, but it's also much further away. So I may want to adjust that soon as well. But I'll save that downside protection adjustment for another time. So everything's looking basically how I want it. The delta is slightly negative at the moment, but that's fine. That'll automatically get adjusted as I adjust the shorter dated positions. You can see that negative delta is basically coming from the shorter dated positions at the moment. So as I roll these shorter dated positions to be more delta neutral, that'll also neutralize the portfolio delta as well. So quite a few trades in today's video. Thanks for watching, and I'll see you next time.